Welcome, everyone. We have another great video. We got lots of good questions. This one very topical. Came in from Crystal asking, interest rates are dropping. How does that impact my retirement? We're going to tackle that head on, look at the ways it could impact your retirement and possible ways and solutions about what you can do about it. But first, let's talk about those rate cuts.
Yeah, and basically we were looking at the rate cuts and the impact they've had. The Bank of Canada meets roughly 8 times a year. So roughly every 6 weeks they meet, and then they make a decision as to, am I going to raise rates, am I going to lower rates, or am I going to keep rates the same based on what the economic situation looks like. So as we can see sort of for 2024, we've already gone through the majority of these.
7 of them are done.
Exactly. The other ones are coming up, and then we're going to go into early 2025. What we saw at the beginning of the year wasn't much, but what we've seen recently is that there's been rate cut after rate cut after rate cut. And we could continue to see some of that going forward, just based on the way the economic system is at this point in time.
Yeah, so the next meeting, December 11th, and more in 2025. I mean, the trend of lower rates, if folks are just hoping it stops, unlikely. So lower rates are probably coming. That was the message. How does it impact retirement? Well, everyone's retirement is going to be a little different.
It does.
But the big impacts, if you're one of the folks that have some debt, you have a mortgage or variable line of credit, well, good news.
This is in your favor.
Debt just got cheaper. But that's not many retirees. Most folks are retiring without any debt, and where they feel the pinch here is on the low-risk investments.
Yeah, that's right. And that's the basic thing. So basically, if you look back, I mean, GICs were roughly about 5%, at least for a year, and they were great. And now what we've seen with 3 rate cuts of a quarter point each, well, now you're getting closer to that 4%. And if you're going out further than the 3 or 5 year range, you may be looking at 3.5%. So we're seeing these rates coming down, and that's going to have a bearing as you renew things. As things come due, as opposed to getting that 5% again, now you're getting that 3.5%. It's going to have an impact on what you're going to get for your returns and maybe what you're drawing out on a regular basis.
Yeah, that's always the risk. You're always picking your risk when you do investments. It's always a trade-off. And with a GIC, you get a very nice guarantee of your principal. You have a guarantee of return, but the risk is interest rates.
That's right.
You get a lock-in for that period of time, but when it comes due, who knows what you'll get? And now we know the answers. It's going to be lower. And likely that trend will continue. So that is the risk. As that comes up, you're getting 5 and 6. Now you're only getting 3 and 4. Or perhaps even lower if rates continue to fall. And then in general, low-risk investing, there are options. So if you're saying, all right, I got these GICs, what is the option? So, a few years back or 18 months back, I said, I got too much stock. I don't like the risk.
Let's
move it heavily to GICs. Now rates are low, and I'm trying to look at options. One of the options could be bonds. You could do an individual bond, which could be hard for an individual investor to buy, just tricky in that market, but you can get ETFs that kind of do it for you.
That's right.
Bonds
they tend to be a little higher.
Yeah, bonds have more liquidity. You can buy and sell them a lot easier than a GIC, so you're not locked in for the full term. You can get more regular cash flow, but the rate of return will pretty much follow interest rates.
So so it'll still go down.
Yeah, you're not going to get a higher level there. You just have a few more flexible options there with bonds. Annuities could be another option.
Yeah, annuities inside of an insurance contract tend to be one of those things. I mean, most people hadn't looked at those over the last number of years because with an interest rate at 0, annuities weren't paying really much more, so you weren't getting anything. But, if you have interest rates closer to 5, now all of a sudden this makes a good scenario. Even if rates are coming down, chances are you can still get a fairly decent rate on an annuity and go from there. That's another possibility. Mortgages become one that you can look at because, again, mortgages are at a higher rate right now. If you're investing in them, they are going to come down and follow that same sort of suit, but you could get a little bit better of advantage than you could off a GIC. And then that could lead us also into the private credit scenario.
Yeah, private credit, which was quite popular following 08, 09, because they did very well during that time.
Oh, big time.
Made money while everything else was falling, and it's continued to see demand increase for private credit. And not all these investments are the same risk. You have to keep that in mind. All of them probably fall into that low-risk bucket. But the idea being if you're all GICs, now GICs coming due at a lower rate, and you still want low-risk investments, here's our other options to consider. The general trend, though, is with low-risk investments, they tend to follow rates.
They will.
So private credit, for example, is usually a higher return than your GICs, but both of them could be a little lower in a low-rate environment.
Yeah, they all tend to manage that same sort of spread. So if you're getting 7 off your private credit, now maybe you're getting 5 if you're getting 3 off your GIC when you were getting 5. So those will all sort of follow the same sort of scenario that goes forward.
We'll go through more solutions specifically and how to deal with the impacts of low rates on retirement. But first, we got this question from Crystal. If other folks have questions, how do they get a hold of us?
They go to chatwithclintonandkevin.com. You can find that on our website or just type that in. We're more than happy to answer questions on rate cuts and how they're going to impact you. Or if you have any other financial matters out there that you want to discuss, please send them in. Those go directly to Clinton and myself, and we'll be the ones responding to you with the answers. No robots involved at all. So it's the two of us, and we'll make sure that we get back to you as quickly as we can.
Yeah, so the big piece here for rate cuts that I always come back to, investments have to follow the financial plan. So you don't want to do the
Yes.
investments and then worry about the plan second. Should be the other way around. So part of that is you can revisit your plan. You can look at from a different angle. What kind of return do I need to achieve my financial goals? Some folks need 4 or 5%. Hopefully, don't need 8 or 9.
No,
That's an unrealistic plan
trouble.
to expect 8 or 9 every time. Most folks will, okay, 4 or 5 is the highest. We'll go with the rate assumption.
Yep.
But if perhaps in your situation, you only need 2 or 3, and then all your goals are still on track. If that's the case,
Buy the GIC.
perfect. Don't change. You just get the low rate, but your plan's still on track. Or if your plan says 4 or 5 is what's required, and now GICs aren't giving you that level, you can make a few changes. Effectively, you'd probably have to change the risk, include some of those other low risk options, or maybe even include some stocks in that mix.
Exactly.
But, and here's the key piece, is you can add a cash flow solution. One that we often encourage folks to consider. Goes by a lot of names.
Yep.
Marketing, some people call it the cash flow wedge. Some people call it the cash buffer. I've heard it called cash damming. Pick your marketing term. It's all the same thing. But the idea is you build in that comfort zone. You build in that safety net, which allows the rest of the portfolio to do its thing.
Yeah, and this is the main reason why you want to have a conservative financial plan that you put forward there,
Yeah.
so that you can maintain some of these things. But as Clint mentioned, that cash wedge is very important. And the reason is because, as you said, if we're increasing our risk and putting it into stocks, well, you don't want to sell everything when everything is down. We've seen that in 2022. We saw that in 2018. There was 08, there was 09, and it lasted into 010. You want to make sure that you have something that, in case you're adding a little more risk to the portfolio, you have something there to draw on. And that's a big factor, because if you have that cash piece, you don't really matter if 1 year's going down or a year or two has gone down. You have enough to be able to maintain your situation as is. And that's always a positive to have. It's a little portion you add into your portfolio. It may not have to be a vast portion, and it can still give you the same results.
Yeah, and comfort zone will be different, but usually 2-3 years worth of payments. And this is why the plan is important. So you need to have an idea of how much you depend on your portfolio
That's
to meet
exactly
all of your
it.
needs. He's okay, this is the cash flow need from the portfolio.
Yep.
And then you can structure it and say, all right, we're getting a little bit from dividends every year. We'll add that cash flow, but we need a lot more. So we're going to build a wedge. We're going to have some bonds, GICs for that wedge, and then the rest of the portfolio, if there is a down market, because that's the risk. You had all
That's the big one.
GICs. Now you've moved to this portfolio with a little more risk. If that stock portion goes down and you don't want to sell, you got this wedge. You can just use that. Let the stocks do their thing and recover. Quick example here. Jack and John were very original with their example names. Let's say they have $500,000 of savings. They got pensions from work, CPP, OAS, but they need 25 grand from their portfolio to meet their spending needs. So we've done the plan, and we know we need 25 grand from the portfolio. So see, plan first, portfolio second. Now they can invest that 450,000 instead of just sticking it all in GICs. They actually do a bit of a portfolio, but they keep, and this is the whole wedge, they keep 50,000 or 2 years of their payments in GICs or some kind of short-term guaranteed investment. That way, if the stocks drop or there's a bad market, they got 50 grand or 2 years of payments to use up and let everything recover. That's the idea of that cash flow.
And that's what you need, right? I mean, that's the basic thing. Because, I mean, if you had all 500,000 in there, and we did see the market go down like it did in 2022, all of a sudden you may be drawing from a base of 400 or 450,000. There's 50 grand automatically gone. Going forward, trying to recapture that, you're going to need substantial returns, and you may not be able to meet your plan's necessity. This way, by having it that way, we've got our 50 grand already taken care of. We don't mind that the market's gone down. We know it'll eventually come back, but at least we're getting money in between.
Yeah, so an idea of the solution, we're all GICs. There's other low-risk options, or you could build a portfolio, but include that cash damming to make sure it doesn't have a big impact on your overall cash flow. We went through this very high level.
Yes,
we have
we
a
did.
video that dives deeply into this exact topic, how to safely draw down your portfolio. Click on that one. We'll see you again very soon.
Take care.